Despite being a small cap, Perimeter Solutions has a monopoly as the only supplier to the federal government to supply fire retardants to stop the spread of wildfires. With enormous cash flows generated from this segment, Perimeter is taking a page from Transdigm's playbook to expand into other verticals that are mission-critical products with high regulatory barriers of entry. Should come as no surprise, though, as Transdigm's co-founder serves as co-chairman of the board of directors for Perimeter, so investors are hoping he can guide Perimeter to the same returns when he scaled Transdigm, which has a market cap now that is 25 times larger than Perimeter's $3 billion market cap today. To understand if this is feasible, let's first understand what Perimeter Solutions does. Perimeter Solutions has two business segments, fire safety and non-fire safety, which they are calling specialty products. Their fire safety segment is their primary business right now. They recently signed a 5-year deal with the U.S. government to be the sole full-service supplier of fire retardant chemicals to stop the spread of wildfires. It truly is a monopoly, as to be a supplier, it must clear regulatory hurdles, which right now Perimeter's foam is the only product that is on that list. Now down the road, if someone else clears regulatory hurdles, they need to compete against Perimeter's Never Fail service network for logistics and distribution throughout North America. With long-term contracts as a sole supplier, this is a very profitable segment for Perimeter that gives them a nice floor. From a financials perspective, this segment provides 2/3 of the 2025 revenue thus far at $158 million. With 67% adjusted EBITDA margins, it demonstrates its monopoly power and generates $88 million of the profit, roughly 80% of the adjusted EBITDA for the year. Unfortunately, too, there's a long-term trend of hotter, drier climates that will drive volume growth for this segment, as drier climates create longer, more destructive fire seasons. Based on this, I expect at steady state, Perimeter will have 10% annual revenue growth for this segment, with 5% growth from volume and 5% in negotiated price increases. Pretty solid growth for a boring, high-margin segment. With this enormous free cash flow generation, this is where the Transdigm playbook comes into play. Perimeter will allocate this capital to acquire niche market leaders that are small cost components, yet are critical to the final product's function, which would give them pricing power. Their targeted returns for these bolt-on acquisitions is for 15% returns or growth. Most recently, they acquired a printed circuit board supplier, IMS, which adds to their existing portfolio in the specialty product segments of lubricant additives. Overall, I wouldn't be surprised if a decade from now, the specialty products segment becomes Perimeter's main revenue generator, and with Transdigm's co-founder on board, I do have some confidence in their capital allocation. Very solid business model that is set up for profitable growth to couple with their fire retardant segment. A key watch out, though, on Perimeter is their corporate governance. Because they came public via a SPAC until 2031, they're going to have to deal with shareholder dilution as they provide compensation to their SPAC owner, EverArc. I am not a fan of this, as I would much rather spend this free cash flow on making the business itself much better, rather than making rich people wealthier. Perimeter's response to this is it provides incentives to their CEO, who came from the SPAC, and its board of directors, which does include Transdigm's co-founder. Looking at a 2030 valuation, and let's first start off with the fire segment's revenue growth. Trailing 12 months is $430 million in revenue. Assuming this grows by 10% annually per the volume plus price growth that we earlier talked about, this gives us a 2030 revenue of $756 million. Assuming the 60% adjusted EBITDA margins hold, and this gives us a $454 million EBITDA for the fire segment. For specialty products, the revenue is stable but lower growth, so let's assume a growth of 5% per year. This gives us $177 million in revenue, which, at the lower 30% EBITDA margins, gives us a $53 million in EBITDA for 2030. Combined, this gives us an EBITDA of $507 million for 2030. For a price to EBITDA multiple, I am using 17, as this is what the leader Transdigm is valued at right now. Putting this all together, and this gives Perimeter a market cap value of $8.6 billion in 2030, which handily beats my 15% annual returns target. As long as Perimeter can execute and acquire niche businesses to be valued like Transdigm's EBITDA margins, I do believe that Perimeter's valuation is very fair. Now, before we get into the technicals and analyze whether John and I will want to add Perimeter to our portfolio, please read the disclaimer in the notes below. We are not financial advisors, and anything we say should not be taken as financial advice. Also, if you like content like this, please help us out and click like and subscribe, as we aim to analyze the most innovative companies twice per week. Now let's put Perimeter through my 5-point framework. From a leadership perspective, I give Perimeter a neutral. They have a strong board of directors chaired by the co-founder of Transdigm, so I do trust that any major acquisition, they'll do a good job of capital allocation. Their CEO, though, is very weak. He became CEO as a byproduct of being the SPAC owner during Perimeter's IPO. His experience was mostly as an investment analyst at some boutique consulting firms. Nothing that screams that he is ready to be a CEO of a multi-billion-dollar company. For valuation, I give this a strong. They have the potential for 20+ annual percent gains over the next 5 years, as long as they can be valued like Transdigm. This would require them to make several acquisitions into niche businesses with pricing power. From a revenue and profit perspective, I give this a neutral. So far, most of their organic revenue growth comes from their fire safety segment, which can grow at 10% annually. Good, but not great. They really do need to grow the specialty products segment via acquisition. For total addressable market, as of right now, I give this a weak. Their main market right now is serving wildfire avoidance, which they already have a huge base of the governments in North America. To grow, they'll need to expand into South America and Europe. But overall, this is just a little bit too niche. For tailwinds, I give this a neutral. There is a secular tailwind that wildfires are becoming more frequent and larger, which will boost Perimeter's core business. This is just not a tailwind, though, that supports 10x growth, so Perimeter, again, needs to take advantage of this cash flow they're generating to really buy into a niche with a larger total addressable market. With that said, overall, I am a no on Perimeter. They are not a future Transdigm. Transdigm was able to be successful despite selling into niche components, since they have these components serving a large total addressable market, the defense and aerospace industry. Every acquisition they made was within this industry, so provided Transdigm the opportunity to cross-sell. Perimeter, on the other hand, already has a monopoly on the full-service chemicals for wildfire segment. They are aiming to acquire companies in completely different industries with little to no synergistic opportunities. It's a bummer, though, as I was excited at first about Perimeter's free cash flow position and them being a small cap monopoly. What do you think, Dad, as you review Perimeter Solutions?
Thank you, Scott, for that excellent presentation and analysis. Okay, I'd like to go over Perimeter Solutions from my point of view. And the symbol is PRM. Right now the price is around 22. So for the company fundamentals, it has no dividend. The beta is 1.98, which means it's 98% more volatile than the S&P 500. And the market cap's around 3 billion, and earnings comes out before the market opens on October 30th. So that's coming up. That's just right around the corner. So for that, I'm neutral to negative. Okay, now let's go to the earnings history. For the last 4 quarters, it's beat only 3 of 4 the last 4 quarters. And, the companies provide analysis with the information. So they should beat almost every quarter. This is only 3 of the last 4 quarters. So that's a neutral to positive. Now for the financials, The net profit margin is 13%. Debt to equity is 68%. And it has no PEG ratio because none of the companies can really predict their next 3 to 5 year earnings history. So the PEG ratio is not applicable. So for that, it's neutral because of the profit margin and debt to equity. That's almost being a little generous, to be honest with you. So anyway, so that's a neutral, as I said. So number 4 for the stock technicals, for the moving average, as you can see, the 50 is above the 200. The 200 is positive slope, and the price is above both. But I gotta say, the 50-day moving average, the price is right at it right now. So it really has to hold this price because it has a long way to go down if it's going to hit the 200-day moving average, because that's the next place that it has to hold, and that's, as I said, at 15. So personally, I feel that the perimeter solutions is overextended right now because it's basically 50% above the 200-day moving average. The price it's around 22, and the price of the 200-day moving average is at 15, so that comes out to around 50%. That's pretty high. Okay, for the Bollinger Bands, they're pretty tight. The Bollinger Bands are tight. For the MACD, no, excuse me, for the slow stochastic oscillator, it's 37, which is neutral. MACD is neutral, as is the unbalanced volume. So for that, I'm giving it a neutral to positive. And then for the analyst coverage, it has 1 hold, 4 buys, and 1 strong buy. And institution is 88%. The analysts predict the buys and strong buys. They're looking at 25 to 26, so dollars a share. So that's their opinion, not mine. Anyway, so in conclusion, I think that I'm a wait and see on this one, Scott. I'm not a no, and I'm not a yes. I'd like to like it because it's a legal monopoly, but it has to hold the 50-day moving average. If not, then, like I say, it's got a long way to go to the 200 days. So, yeah, so, and plus earnings comes out on October 30th. So I'm personally going to wait till see how the earnings comes out. So, and also, it is weather dependent, this company, and also the share delusion that Scott was talking about, the company structure. It could dilute earnings. So, okay, Scott, back to you.
Thanks, Dad. Overall, we are both a no on perimeter solutions. They're a monopoly, but in too narrow of an industry to be able to acquire companies to cross sell with. So their best case is to become a private equity firm and buy companies in other industries. I think there are better allocators in private equity, like QXO's Brad Jacobs or BlackRock's Larry Fink, than Perimeter's CEO. With that said, thank you for watching. Please help us out and click the like and subscribe button to keep up on our journey as we analyze the most innovative companies twice per week. Until next time, happy investing.